Hello, everyone. On behalf of the Councils of Real Estate, welcome to this presentation of We're Not in Kansas Anymore, a special webinar by select members of the Councilors Organization's Economic Advisory Council. Thank you for joining us. My name is John Bachesky, CRE, and I'm the 2026 Global Chair of the Councils of Real Estate and President and Founder of Real Estate Fiduciary Services in Somerville, South Carolina. The Councilors of Real Estate is a global organization of commercial property advisors and has long been a beacon of thought leadership and problem solving across our industry. The organization's strength lies in the diversity of expertise and experience among our distinguished members, those that have earned the prestigious CRE designation. Please visit cre.org to review our membership criteria to determine whether you, too, might be interested in joining our organization, and where you may also subscribe to our peer-reviewed journal, Real Estate Issues, which is available at my personal price point, free. You're encouraged to utilize the Q&A feature should you wish to submit a question. Your participation is welcomed, and we'll answer as many questions as time allows. It's my great pleasure to introduce my longtime friend, today's moderator, Jim Costello, CRE, Chair of our Economic Advisory Council and Chief Economist at MSCI Real Assets. Jim has worked in the commercial real estate space since 1990, including a 20-year stint with the former Tordo Wheaton Research. Jim is a prolific speaker and writer on real estate and urban economics, and is known for pairing forecasts with frameworks to answer investor questions on market performance, asset values, and investment opportunities. Many of us have been fortunate to hear Jim's cogent analysis over the years. Welcome, Jim.
Thank you, John. Calling me cogent first thing in the morning. Thank you for that. But today I'm more interested in hearing what our panelists have to say about the world. We've got three great folks here: Will McIntosh, Will Pattison, and Josh Harris. What my role here? I'm going to moderate. I'm going to be asking questions. That's really the best way I've found to get stuff done, is just talking to people, asking questions, and I learn that way. So we had a great organizing call. In some ways, kind of wish that everybody listening today could have sat in and heard our earnings call. What am I talking about? Our organizing call. Because the topics that we're going to talk about today, we're going over them then and talking about the ideas. It was a very great back and forth. But what I thought I'd start off with, we did this a week ago, and the world has been changing dramatically over the last week. So I'm going to talk to everybody one by one here, just get them to give us a brief introduction about who they are, what they do. And then what I'd like each of you to talk about is, since our call, what topics have been on your mind in the last week that have suddenly become much more important than maybe you would have worried about a week ago? Will McIntosh, compared to a week ago, well, for number one, who are you? And what do you want the world to know about yourself, briefly? And then, what's been on your mind on the economy over the last week?
Yeah, great question. Well, as you know, I wasn't able to make the call last week, but I can definitely tell you what's on my mind. I will say this. My name is, again, it's Will McIntosh. I'm a CEO of ArtBridge Research Group. We're a new independent third-party research firm that is dedicated to helping our industry be successful. And in terms of what's on my mind, we've had a lot happening the last few weeks, not the least of which is we've been involved in a military action, and there's a lot of concern about what that's going to mean for the economy and real estate markets going forward. And so there's a lot of concern about it, and I think if we can keep this military action a short-term process, then I don't think we'll see that much of an impact, thank goodness. But if it drags out for a long period of time, I think we're going to see a situation where we're going to see energy inflation happen in a significant way, and it's going to have a significant impact on the economy, and therefore the real estate market. So that's the one thing that's really popped into my mind recently, and something that I've been focused on.
Okay, thank you. Will Pattison, can you introduce yourself and then tell me what has been most important on your mind in the economy over the last week?
Yeah, so my name is Will Pattison. Thank you everyone for joining. I am the global head of real estate research and strategy for MetLife Investment Management. We have a pretty large portfolio across the US, Western Europe, a few Asian countries, South America, in both debt and equity. Uh, at the risk of getting the same answer about Iran and oil prices from all three of us, I'll say one thing that I put in second place has been I've gotten a little more optimistic about brick and mortar retail, and that's because of the release that came out this week showing a continued slowdown in the rate of growth of e-commerce spending. So that is a factor that it's really we've really been watching that closely since the pandemic when everyone was sitting at home watching Netflix and buying everything online, and we had a surge in e-commerce spending that slowed down or pulled back to some extent, and seeing where that stabilizes is going to tell us a lot about what the value of retail should be today. And again, the release that came out this week has been another confirmation that e-commerce spending is slowing back to a normalized level at a pretty quick pace.
Okay, thank you. And last but not least, Josh Harris. We had to have somebody other than named something other than Will in the call. But Josh,
as the
tell,
as the
tell,
name as the name diversity player. So hi, I'm Josh Harris. I am a professor at Fordham University, and I also do consulting for my group, Lake My Group, and I work for a family office called Crossmark, which actually focuses mostly on retail. So I just Will Pattison. I'll have to slip you the $20 later for the nod on retail. So, Jim, it's a great question. Just the mere fact that you asked, hey, could you update us on what has changed over the last week? Kind of tells you about what an interesting event-driven world we're in. The fact that, and look, I have had this statement that we have been in kind of a black swan-driven world really for a long time, but it's like these last years, kind of since COVID started, it's just, oh, here comes COVID. Now there's social unrest now, and war in Ukraine, and I mean, and all these. In fact, I think the last maybe I don't know if we want to call Iran a black swan or not, given I think people expected all these things, but I think it was November 30th of 2022. That's the date that ChatGPT went, live to the public audiences, which probably looked back as a technological black swan. So, with all that said, the thing that has probably been more keeping me eyes fixed. I don't want to say that I'm worried necessarily, but the private credit market stories, which if you're not following this, and private credit is a little bit of a cousin to private real estate, especially if you look at the way the capital markets and the large firms that raise these funds or raise money. And real estate kind of went through this time a few years ago. So if it didn't shock anybody because everyone knew, well, interest rates went up, real estate might be more difficult to sell or trade. Private credit is now kind of, there's all these different funds that are by necessary, limiting their redemptions or their liquidity, which is really just a function of cash on hand versus more and more people trying to run for the exits. So I don't really know what's happening in that world because it's not my world, but I do know that real estate is very adjacent to it, and having investors out there who write equity checks getting scared is typically not a good lead into other things. So it might be an absolute nothing burger, as they say, but it's what I've been talking a lot about, thinking about, and in addition to the Iran war, obviously.
Okay, well, thank you, Josh. Yeah, so three topics here that have been on everybody's minds a little bit more over the last week. But I think, Josh, I think what you highlighted there, everything has been event driven recently. All these black swans. It's not like a typical economic slowdown of, oh, the auto manufacturer made too many cars, therefore They have to have some layoffs. Therefore, there's a rebalancing of inventories. It's as if we have all these one-time events that call into question sort of the structures of the economy and all the underlying connections, and that makes them more difficult
I,
kind of challenges to work through. But
yeah.
let's start with the big one that Will McIntosh brought up first. What's happening in the energy markets? What are the chances of a big inflation spike the longer this goes on? And Will McIntosh, I'm particularly interested. Folks may not know this, but Will's currently in Cannes, well, actually in Nice, but he was there for MIPIM. And Will, what was the attitude of people there at MIPIM, particularly a European audience, about all the turmoil in the Middle East, and what does that do, given the uncertainty? What does that do for what they want to think about putting their money to work in real estate?
Yes, Jim, that's a great question, and you bet it's on their minds. In the discussions I've had here over the last couple days, obviously they're very concerned. They're very concerned about what it means in terms of economic impact and how it's going to affect the market. But I will say this. They're planning on continuing to invest in the U.S. For a number of reasons. While they do worry about the uncertainty that continues to grow. They view the U.S. real estate market as a market where they need to be. It's got the largest investable real estate investable universe in the world, and they're going to continue to play. They're just trying to figure out how best to do it, and where should we invest and what property types, and what don't we know that we need to know? And so they were asking a lot of good questions, but the interest level is there, and that's even showed up in a recent survey that AFIRE did to their for their international membership. They all were very clear that they plan on continuing to invest in the U.S. and probably picking up their investment somewhat going forward because they view the U.S. in part as one of the safest places they can invest in the world, and they're not going to ignore it.
But the risks around inflation, some of the concerns about the economy that we'll get into in a bit, those don't matter as much, do you think, as the safety elements that the U.S. provides?
Yeah, I think they matter, but not as much as the safety. I mean, they've still got their capital to deploy, and where are they going to put it? Um, for a while, they were putting most of it in Europe more recently, but they've clearly indicated in some of these recent surveys that they plan on increasing their U.S. allocation going forward. And again, they're just worried about how best to play it, and that's what I heard. I didn't hear anybody say, we're not going to move forward with investing in the U.S. Or we're not. It's difficult. It's not like they can go to the sidelines because many of them have demands on their investment activity such that they need to get invested. So stay tuned. We'll see how it plays out.
Okay. Josh, Will Pattison, what issues have you been watching in the economy as it relates to the turmoil in the Middle East over the last week? And a question I've been getting a lot from folks is, what's it doing to commercial real estate right now? Which I tell folks, hey, it's a slower moving asset class. You're not going to see an immediate reaction. But have either of you had much time to think about when we'd see some challenges hit the real estate market if things drag out, as Will McIntosh was highlighting, that is where the problem could be. If this drags out longer, it creates more inflationary issues. When might it be something we could worry about in the commercial real estate world in terms of seeing actual
Yeah.
activity like that?
Well, personally, I would expect commercial real estate to be more on that second and third order consequence chart. I mean, look good or bad, right? Real estate is a fixed asset. It's here. Obviously, if God forbid Iran or whomever, physically could strike the U.S. or something like that, that could change that very quickly. But in a more macro sense, I think this is actually to back up what Will McIntosh just said, is that there's this there's this concept, especially with AI, which is like we got quite far into this call without anyone really saying it, which is maybe saying something of itself. But maybe the trade now is for what's called halo assets, which is I've heard this among some of the stock traders, which means heavy asset, low obsolescence. And it is noted that real estate fits this, commercial real estate, right? I mean, we haven't potentially an AI model might take your job, but you're not going to be able to sleep in a Claude model, right, or something like that. So there is still people who might turn more towards heavy asset type thing. So I actually think one of the interesting consequences of even this, all this global, craziness, whatever I mean, is lots of ways to say is that, hard fixed assets, real estate might actually look a lot more attractive. Now, what we haven't seen, and we could get, this is a long debate that we could have, but we have not seen the normal thing where, hey, there's market craziness, 10-year treasuries and all the bonds get purchased and the yields fall, right? So in fact, they've modestly gone up since all this happened. People are not too keen on U.S. debt for lots of reasons, clearly. But I actually think that a consequence of this, Jim, is that people might want to invest more heavily into U.S. commercial real estate as a bit of a safety. It's a long-term play. It's a safety thing. It's got some hedge inflation ability. So that to me is maybe the most obvious thing. Over the now new development could get, I don't products and flows and certainly oil prices. I mean, it's not great for construction prices, that I know, but that's a little bit more second order on it. So that's
Yeah.
kind of what I think.
Yeah, and the construction element is something that it's going to take some time for that to show up as well. We're already on a downswing of construction for most sectors, but then higher costs that could create more of a problem for that. And Will Pattison, what are you looking at in terms of timing of if things go extended and take longer in the Middle East? What are you looking at in terms of timeline of when it might impact commercial real estate?
So I've heard of two cases, neither of which my firm was involved with, of something that could almost be considered retrading over the last since Monday of last week. Although I wouldn't say retrading, I would say being very aggressive about due diligence findings while an asset is under contract. Triple B corporate bond yields are up about 30 basis points over the last month and a half or so, which suggests that 10-year unlevered discount rate should probably be up something like 30 basis points compared to where we were in the past. At least historically, there's been close to a one-to-one relationship there. So I've taken a little bit more of a cautious view. I think I'm sometimes accused of looking too much at where the corporate bond yield market is, but that would be at least in the near term a place to look. I think bigger picture of energy prices stay high, and this is maybe beyond just real estate. That could be what deflates AI speculation or the AI, I don't want to say bubble, but the firms that are in high growth modes, if they start seeing higher expenses as a result of rising energy costs, that could certainly be a headwind, not just for data centers, but for the economy.
Yeah, that it's interesting though, the AI and data center and the energy cost stuff. I want to dig into that a bit, but I want to go back to your corporate bond statement because that's something. It's something I look at, and we didn't talk much about that in the initial prep call. But yeah, a 30 basis point increase. If that's sustained, uh, then investors in basically those corporations are the tenants of all these malls and industrial properties and office properties. And if they're saying if the market is saying that their debt is 30 basis points riskier than it was a month ago, and if that's sustained, then should the risk of the cash flows of the rents they're paying change? So it implies a cap rate increase.
Yeah.
So are you worried that might lead to more of a slowdown in deal volume into the second, third quarter if suddenly the capital wants a higher rate of return for the risk? The current owners probably don't want to sell yet. Or does it lead to more capitulation, folks who are already kind of hanging on by a thread? Have you looked at that issue?
You're asking the right question. I mean, all I can say is uh, I was everyone's friend in our acquisition investment committee a month and a half ago, and I'm not quite as popular today because I'm viewing the cost of capital as being a little higher now than it was. But yeah, I wish I had a better answer for you, Jim. That sounds right, but I don't have any detail to add.
Yeah,
Jim,
that's
I
go
think
ahead, Will.
Jim, as well. I think this has implications for valuations too. We like to think we're at or near the bottom on in these valuation corrections that we've experienced, but if we see the basically the cost of capital going up. If we see that investors are demanding now a higher return, it could impact more values and write downs in these assets going forward. So we may not be at the bottom yet if this continues. And to add on to that or pile on to that, I guess I would say. I worry about the fact that the government's carrying a lot of debt, and we know that that debt has to be financed, and the Treasury has got to sell these 10-year. I worry about the 10-year a lot, where that's going, and I'm seeing forecasts that even though today it's at roughly 4.2, that it may continue to move up to maybe 4.5 this year and beyond. And it may take that to sell all of the bonds that the Treasury needs to sell to finance our debt, particularly as it gets larger. And again, that has implications for cap rates. And, you know, if we're trying to maintain a spread over whatever the cap rates are, as well as the BAA or triple B corporate bonds. So there's a lot here to to make a meal on in terms of being concerned about what happens with interest rates and cap rates and real estate valuations going forward. I'm
Yeah,
like Will. I don't want to be the bearer of bad news, but it's we got to consider all of this.
yeah. I mean, number one, that's the role of the researcher in a lot of places. Sometimes, yeah, sometimes you're going to be their friend, sometimes you're not, and you still have to go forward with your ideas and have an idea and stick with it, have an argument and stick with it. And sometimes that's going to win, sometimes it's going to lose, but on average over time you're going to win more. But I wanted to connect the dots on one thing that you said, Will, with something that Josh said. um, you described a market where and I'm going to throw this out there just in connecting the dots, an observation about how they're connected. I don't have an actual question about it. Maybe somebody will come up with them. But Will, you're talking about this notion that people were thinking, hey, valuations are at the bottom, almost like in a nice smooth, well, prices went down and then it follows a nice curve and then it comes back up, uh, almost as if it had done that a number of times before in everybody's career. Here listening today, everybody was expecting there'd be a nice, simple kind of prices down, the market resets, deal volume increases again, prices stabilize. But the world isn't moving in a sine wave anymore. This is not this long construction driven price cycle that we saw in the 1980s and 1990s. It's driven by, as Josh described, a series of black swans. It's all these external shocks that are changing some of the fundamental assumptions that people had in the market. And so you think you're on the sine wave on the way up, but that's not the driver anymore. It's not going to follow that previous path. It's reacting to all these one-time events and shocks outside of the system. So, some of the old analogies just may no longer work if you're thinking about things in just a purely a cycle comment. Um, so I'm just connecting the dots there. I don't have a question that
I,
goes with it,
I
but Josh?
Well, I was gonna say if a lot of these are somewhat of a, if you think about the real estate, there's somewhat this battle of what's inflationary, deflationary, right? Because I mean, when you think about, bond yields. I mean, the trouble with bonds, and is the very definition of fixed income is that it's fixed, right? So to some extent, if you expect higher inflationary pressures, a bond, which, unless it happens to be floating rate or have some mechanism, right, it has to decline in value, all else equal. Real estate with a longer horizon has a more mixed response, right? In theory, lower construction, new construction, the better power landlords have in order to push rents, equal higher rents, all else equal demand, but also you got to factor higher op costs and certainly capex, right? So I think a big question, this is for all the counselors out there, it's like, especially if you're having to do appraisals or whatever, like, do you think your any particular type of real estate market or whatever you're looking at, can it and will it act as an inflation hedge, right? Because if it can, it should go up in value, right, on some relative basis. If it's going to be more subject to the downsides of inflation, then it should be hurt, right? So I mean, we could see those spreads with bonds, get diverge, and it probably won't do it smoothly. It probably will be more true for certain asset classes, maybe even certain markets than it will be in others. But I feel like that's a fundamental question. I think all the CREs of the world and all the real estate practitioners have to contend with.
Sure. So anytime folks are listening, some new black swan happens, first question to ask yourself, is it inflationary, deflationary? And then that's going to help you think about how it impacts real estate down the line. But let's move on to another topic. I want to talk about tariffs and trade because that's still a big issue. We have trade tensions still with folks around the world. Um, there are carve outs out there, so it hasn't hurt as much as people were fearing. But who's actually being hurt by the trade pullback in terms of hurt in the economy and then later, what that means for property performance. I'm going to throw that one out there. Anybody want to volunteer to jump in to start?
I can kick it off. I think, as you mentioned, the tariffs have been less impactful than I think many market participants were expecting in April of last year. The pace of tariff revenue, or how much the government is collecting from these, is around $350 billion per year. That seems to be where it's stabilized. It's just annualizing recent months. That's actually quite a bit less than what state and local governments were already bringing in through sales tax. So just in terms of framing this is not as impactful or some sort of pivot in how the government raises revenue as was feared. It's I think could be thought of as a modest increase in sales tax. In terms of who's impacted, I think that's pretty clearly everyone but the top 5 or 10% of income earners, or it's just proportional to where income is, since the cost of goods has gone up a little bit, there's many exceptions, so it's complicated to talk about this at a macro level, but I think that the tariffs are part of what's behind the K-shaped growth in the economy, where the top 10% or so of income earners are now making up more than 50% of all retail spending.
I would just add that I think kind of what's made the tariff thing kind of confusing, besides for the fact that they change frequently. We knew we were going to be subject to a Supreme Court ruling, and now there's this new one, but it can only last 150 days, and all these things. There's long list of exceptions, which is, and they don't. There's a big headline or a tweet or whatever about the big headline thing, but like there's no press coverage or press release even about the items that get added to the exclusions list. So I think that's partially what happened, why Will's talking about the lower amount of revenue. But the other part, and who knows that this is a long-term thing, is I think a lot of countries, like specifically China, who recognize sort of the direct attack on this and also the threat, they have been subsidizing some of the manufacturers, some of the prices. So they're, combating it by literally making sure that the prices fall, i.e., the other countries like I know specifically China is paying the tariff in the final aggregate price setting mechanism, right? So I think that's partially why it hasn't flowed as much into consumer prices or inflation as it could. And I think that could be a short-term effect. Don't think it. I think over the long term, you're eventually going to see it all kind of more reset itself. There's just tons of questions on how that's going to play, but you know, I think the honest answer is tariff policy is so variant that I think a lot of the market participants said, you know what, let's just ride this out. So there's just been a decision, even amongst retailers. I mean, a lot of I mean, a lot of goods. We don't. I think sometimes it gets overstated. Like it's at that price it's the price that it is as weighted when it crosses the border. It's not the retail price. So I think sometimes people, 10% tariff is like a 10% sales tax. No, I mean that math doesn't work that way. So I think to some extent it's just it's played out a bit more blustery and doesn't mean it can't. I mean, we just don't know. I mean, now the courts are involved, so I I don't want to call it a nothing burger, but it just is not. I think what anybody. I think that's why the markets have just kind of given up caring about it, because I think they realize that this is kind of like nowhere near what it's unlikely to be what the worst fear about it was, like what it was about April of last year when all that started.
You
So
know,
go
Jim,
ahead,
I
Bill.
think just a couple thoughts to follow on that. I think that this is putting added pressure on the Fed and to decide uh, where they think inflation's going to head. I think they are concerned that even though we haven't seen a major impact of the tariffs yet, that there's still some risk there. That because of certain items being impacted, that the PCE, which is the inflation measure that the Fed watches most carefully, it's been hovering well above the 2% target, and I think they're concerned that it's perhaps not going to come in the way they hoped it would, in part, not totally, but in part because of the tariffs. And then if inflation takes off because of an extended war, that I think they're less likely to want to reduce the federal funds rate. And I mean, a lot of people are saying 25 basis points. It's currently setting at 3.5 to 3.25. That maybe they'll reduce it another 25. But I heard Peter Linneman the other day call for a 75 basis point reduction in the federal funds rate. Wow, I with everything that's going on now, I love Peter, but I would have a hard time to buy into that at this point. And I do think the Fed is in part waiting to see just how big of an impact the the tariffs are going to have, but now especially with the possibility of this war being extended, that they're going to have to be extra careful. So
But
people who are, yeah. Anyway,
I mean, I mean, again, it's sort of the black swan kind of thing. It's people trying to make an investment, and you have a lot of uncertainty around these issues, but the impact is only kind of sort of felt, and decisions are deferred because you're not quite sure what it's going to look like yet. The obvious impact on tariffs is trade, which and so the obvious real estate angle on that is what happens with industrial demand for warehousing and logistics space. Uh, I mean, is it fair to say that people, as they're underwriting, are looking at this and they're trying to watch it, but there's just too many moving parts, and so they're still doing mostly what they did, or is this impacting anybody's thinking on how they value industrial real estate? Does anybody want to jump into that?
I think we have seen cap and discount rate increases over the last year at port markets. So I think that part of it is getting priced in. Although I wish I could tell you if it's overcorrected or undercorrected. It's such a complicated
Yeah.
question. Outside of that, goods are still trading at a normalized pace. And like just, going back to where these tariffs have had an impact and the K-shaped economy, the price of clothing is up over 10% in the last year in the US. That's the type of thing that probably many of the people on this call have not noticed because this is probably mostly middle class or upper middle class, but the bottom 20, 30, 40% of income earners probably have noticed that. And uh, if you think about what does that do to supply chains, it's probably just meaning we're still getting clothing from Southeast Asia. And I don't think that's causing a renaissance of manufacturing in the US, but so just taking that one example, that doesn't actually mean a meaningful reduction in the amount of goods coming in through the ports. And I think that's where a lot of products have ended up is still not changing supply chains dramatically, and as a result, not really affecting industrial real estate as much as one might think.
Well, there is certainly pressure, I think, on onshoring, nearshoring, reshoring, if you will. We're seeing a lot of that in Mexico, for example. A lot of activity down there as companies try to deal with the tariff issue, but also more importantly, perhaps not just the tariff issue, but dealing with the logistics issue of, being closer to the consumer and not have to deal with the train wreck, if you will, that we saw when we couldn't get the goods when we needed it, and it was all setting offshore in 100 ships off of Long Beach. I mean, we are trying to correct for that, and I think the market is, and that's going to continue, and that's going to bode well, I think, for the logistics market. But to your point, there is some negativity there from the standpoint of where online sales haven't been what one would hope if you're going to be invested in logistics. So.
I would add, I think that, you know, the issue with tariffs and then industrial is that, I mean, we're still going to consume stuff. So it's just the question is, like, do you need more or less warehousing at the Long Beach port because you expect to, because of your trade flows to Asia, or maybe you now need it at El Paso or something like this because you're going to bring more in through Mexico or something like this. So I think that I just think that most industrial users are going to just wait till they have some certainty on this. So I think on net there'll be plenty of demand. I'm not really, I know certain submarkets are probably a bit overbuilt. People, I know there's vacancies in some of these large, million square foot spaces that people thought like large, e-commerce people were going to use that have been slower to lease up. But I I think on net, the long term of all of this global, I mean, I don't want to call it like a deglobalization trend. However, there's been sort of a macro geopolitical force on that. I think a lot of companies are going to be, if I can, especially with roboticized factories and distribution things, I think a lot more people are going to want to onshore when and where possible. But that takes a very long time to actually make that happen.
Okay. But it all presumes that people are consuming still. So using that as my little transition to go to another topic, but let's talk about consumer behavior. Let's talk about everything there. Will Pattison, you said early on that you've been watching that and watching the change in the e-commerce numbers. How is personal consumption holding up? I mean, there's a lot of uncertainty in the world today and fears of inflation. Gas prices went up quite a lot in the last week out here. I wouldn't know. I take the subway every day, so I don't have to really follow it as much. That doesn't hurt me personally as much. But I know some of you guys, it's going to be much more impactful just given where you live. Um, but how is all this impacting the consumer side of the economy? And are people still spending and going to continue to spend?
Yeah, so there's two sources to see this in real time. One is the credit card spending data, which is a pretty expensive data subscription to get that cleaned up and see it. And the second actually comes from us, from commercial real estate. Both of them are showing what I'm now sounding or feeling like a broken record on, but which is this K-shaped economy concept. Just in the real estate space, luxury hotels have seen about a 3% increase in RevPAR over the last year, whereas budget and economy hotels are down something like 4%, according to the STR, Smith Travel Research, CoStar numbers, and that I think is pretty telling. Also, just in the leasing world, we can see this with grocers doing quite well. They're reporting better sales, and within our own portfolio, we're seeing expansions of grocers. That's kind of benefiting from this large population that's no longer eating out as much and instead is using grocery stores. The restaurant industry, at least for what I'd call middle class restaurants, certainly fast casual, has declared itself in a restaurant recession over the last 6 months. But that is not affecting Taco Bell at the bottom end of the curve. It's also not affecting the five-star Michelin restaurants or the ones that are more expensive at the top end. So that the overall net spending has been growing at an okay pace. I think it's probably a little bit fragile though, Jim, because if spending is increasingly coming from the top 10% of earners, that is a group that if they get spooked, they can cut their spending in half if they want to. The bottom half of households cannot cut their spending in half.
And that's a good point. The other thing that's happening with the bottom half is we're watching credit card delinquencies, and they're borrowing more, and the delinquency rate is remaining elevated. So they're going to run up against it here pretty soon. And like you said, Will, it's a K, not only a K-shaped economy, but a K-shaped consumer market that the top end is going to be driving the bus, and the rest of them may not be able to do much to contribute to economic growth. So stay tuned with that. Mm.
I would,
Josh, yeah, go ahead.
yeah, I was going to say one thing that I mean, and this has been true now for going on a couple of years here, but if you look at a lot of the consumer sentiment measures, like University of Michigan's with the Consumer Confidence or the Conference Board, I mean, and this is before this Iran war thing, which probably won't help. Um, Consumer confidence has been almost equal to the levels of the lows that it was at the worst part of the COVID pandemic, like, March, April of 2020, right? So people are as upset about the economy when they're in their view. This is an economic question as they've ever been, or not ever been, but in recent memory, when you think they really should be freaking out. But yet you look at like Census Bureau consumer retail sales, it keeps kind of going up. Now, obviously, those can be linked because retail sales could go up in part because prices are higher and inflation's there and people still need to eat and buy stuff and they're able to do it. They are definitely putting on credit. But I think the big question, and we haven't even talked about this, but like we finally had a true negative number. That's before the revision on jobs that bring seemingly always lowers every jobs number we get. I do think a big question that, like, if it looks like there are sustained mass layoffs or just layoffs in general relative to hiring and we start to see employment falling, um, I don't, that's to me where the word recession comes more realistic. It also means that maybe the Fed does get into their meetings and say, you know what, maybe that's how Peter Linneman's going to get his 75 basis point cut. If like what Will was saying, he was saying, like, because I don't, I've always thought, I've said this to audiences when asked this question about the Fed, why aren't they moving? I said, like, it's like if you go to your doctor and he says you have high cholesterol, take this pill. You come back in the next month and your cholesterol's down. You don't go back and say, well, I guess we can take you off the pill now, right? I mean, they're going to, until something changes, I just don't feel like the Fed has a motivation. But if employment is suddenly gets substantially negative, and we don't know if this was a one-off blip or what in the readings, then they might have a very, very different stance on maintaining a higher rate. We'll see.
Well, I do want to get back to the job numbers. I want to talk about that, but but on the consumption side, I do want to get a little bit into the implications for retail real estate. Early on, Will Pattison was saying that he's in favor of brick and mortar retail now. Well, I've started to see a lot of that as well. Deal volume, people are buying and selling more retail properties. Retail property prices are growing across all the institutional properties we track for the indexes we create. NOI per square foot is now higher than before the pandemic. So, there's some fundamental stuff that seems better for retail. How does the recent change in consumer behavior and potential riskiness in this K-shape, how's it impacting the actual property side? Anybody want to take that?
Uh, I'll take you briefly to say that partially what's driving this, and I'm very directly, my family office group I work for closed on a shopping center the last couple of weeks. We're actively trying to buy in the value add space, and here's the basic some basic math. You can in many instances buy cheaper than you can build, right? So I mean the cost of construction of retail is can be 200 300 square foot even in places like Florida. I mean obviously California and other places get much higher. So if it's not been built, it's a lot harder to get things to pencil. So the existing stuff, like if you're a retailer, finding locations is could be literally murderously difficult, and it has just become you know, very difficult. Like second generation restaurants is one of the hottest commodities in the leasing space market, right? Because all the heavy, restaurants have very heavy expense with grease traps, fire requirements, the code requirements on a restaurant. Obviously you had open fires, you're cooking stuff. So I think that partially what's driving retail is that we've built very little. In fact, I've heard, I have not been able to confirm this data point, that we may even be in many markets net destroying more retail and often to build multifamily or other things. Which does make sense, in some senses. So that's kind of just a very unique thing that, we got so scared of Amazon or whatever, almost 15, 16 years ago, that we haven't built much. We're tearing down malls. So I mean, I think it is part of the reason why retail looks good is that it's got the most active deletion stamp. Will has a. I think I want to throw this to Will McIntosh. He's had a great quote on this in the past. I'm hopefully teeing him up.
Will, can you remember your quote? That's the
I'll
because
say it if he doesn't, but I want to tee it up I don't want to quote the man when he's right here.
Yeah,
well, you
my old quote was the only thing wrong with retail is it's not overbuilt, it's under demolished. And I started feeling that way about office for a while, but I'm coming around now. But anyway, that's been my take on it. But now retail is making a comeback, and if you look at it, the consensus forecast for property type performance over the next 3 to 5 years that PRIA publishes, we see that retail is forecasted to be the top performer now, and core retail in the call it the 7% range, and with residential behind, and then industrial and then office around in the 5% range. But it's interesting now that all of a sudden it's becoming the focus for the higher performing property types.
well, I want to switch and answer an audience question, but it's also got some implications because I want to think about some of the questions we're going to talk about here later in the sense of how's it impacting the office market. But our good buddy Tino asked the question, beyond oil prices and tariffs, do you see structural forces such as change in space utilization, in other words, remote work, population resorting across region, and the adoption of AI automation as having a larger long-run impact on real estate values and development patterns? Effectively, if I can re-summarize Tino's thoughtful question again, we've been talking so far about like what's happening today. Here's a shock, how the market's responding to it. What structural factors are you most concerned about? What structural changes are happening in the world today that you're most concerned about for long run impact on commercial real estate? And especially AI. Can you focus, is it just a fancy new gadget, or do you think there's some fundamental things coming on this that are going to change how everything in the economy works? Uh, uh, who would like to jump in on
I'll
on
take a
Tino's stuff first?
I'll take a go at it. I'm mostly an AI optimist, maybe somewhere between optimist and realist. If I'm not a doomer, if at least as I look at it and think about it. And what I mean by that is I think it integrates into our economy more seamlessly than maybe think people think it is. Like it will eliminate jobs. It doesn't mean there's not new jobs for the people who are employed, right? And it maybe it does lead to more of a leisure in the leisure labor trade off that you can actually have more leisure time, and that actually creates more jobs. And maybe I somebody asked me this, what would you do from real estate? Well, go buy beach property in the most low in low go find low cost beach towns and buy up whatever you can, right? I mean that's one theoretical way to approach this. I I guess fundamentally, I think that there's always going to become more demand. There's this thing called Jovan's paradox, right? Which I think had to do with like steam and coal usage, right? The more machinery made the cost of doing something cheaper, the demand for that product to cheap, goes up. I mean, it's a kind of a classic economist paradox. So I think it's the same true with what AI can do. I also just think that it's a lot harder to pull the human, right? Like that last mile of getting work to be done and trust and where there's legalities to it. I just think it's everybody who's telling me they're going to like, this is going to replace 60% of lawyers, 70% of accountants, and 100% of counselors of real estate or whatever they're saying. Like, I mean, it's kind of like these are all the tech guys. It's like these are the people who are selling hammers telling me how many nails I'm going to be buying. I'm just I kind of feel like there's a production curve on the back end that will change it. It's going to be different, but I'm more so on net. What does that mean? Probably demand for more real estate, right? I mean, the physical stuff is ultimately needed, right? I mean, that unless we just choose not to have any more children, and then maybe we don't need real estate. But that to me, that's kind of the outcome to watch for.
So there's a healthy skepticism on Josh's part on AI and automation. Will Pattison, uh, you must have been thinking about this relative to the office market. Are we going to lose all these office workers to Claude and ChatGPT, or is it going to be a more nuanced situation?
I, I think the first answer all of us could give is I don't know. But let's expand from that a little. The Bureau of Labor Statistics tracks job demolitions in a pretty good manner. And over a typical 5-year period, I looked specifically at 2014 through 2019, there were about 14 million jobs that were, or excuse me, 12 million jobs that were eliminated. There were actually more than that were created. 26 million were created. So creation more than offset eliminations. But just keeping that 12 million elimination number in mind, um, I tried to essentially look at all the reports that have been published on this from McKinsey to investment banks to others to come up with a consensus forecast for how many jobs will be eliminated over the next 5 years. And I concluded to 19 million. And so that is higher than that 12 million figure. The question is how many jobs are going to be created? And I think the answer to that is not zero, which is what a AI doomer might say, but actually quite positive. Until all knowledge is solved, there will probably be a need for knowledge work. The question is, are these large language models democratizing that work, or are they consolidating that work to a smaller number of people who have the best models? So far, it feels like the answer is democratizing. And I say that because you can't get a lot with $100,000 a month that you can't also get for $20 per month today. And that doesn't seem likely to change in terms of just what's available in the large language model space. But so that I have an optimistic view on that. I suspect office work is not going to decrease, or we're going to see a new sell-off in office as a result. But just for all of us who are workers, that 19 million number is painful. That is a lot of turnover. That's a lot of people losing jobs, needing to find new industries, reinvent themselves.
I would add to that too that I think there's going to be some retooling, retraining. Uh, while yes, we're going to lose quite a few people, I think it might not be as bad as we think because I think companies are going to give their employees an opportunity to retool and really embrace AI going forward. And I do believe that the impact on the office market is still significant because and it's a bifurcated situation where the older buildings, as office employment does decline somewhat, the older buildings are going to be at risk. And As I said earlier, I think some of them are going to need to be demolished because they won't be able to be repurposed. It just won't be cost effective. And I think if you're looking at office and you're focused on Class A, you should be good because and we're seeing it in New York now in a major way. A lot of the major transactions that are occurring and things that are trading are these Class A office buildings in New York, and we're seeing it now in D.C. and San Francisco as Silicon Valley is very active. So stay tuned with that. I think there's it's going to have an impact on the office, and it's if you're going to be a player in office, you need to focus on the higher quality office space because the older stuff is going to feel the impact.
So we've only got 5 minutes, probably even 4 minutes left at this point, and I did want to talk a little bit about jobs. There's so many things I wanted to talk about. We just got into this discussion. It just goes easily. Uh, but jobs, the job numbers last week were down, negative. The month before, they were positive, and the month before we had some really good numbers on construction, which everybody I talked to thinks it was kind of related to data centers. But yeah, it's zigging and zagging after a shutdown for a bit that delayed updates of data. How much do you think is real? Just the economy is uncertain. There's a lot of noise at the moment versus how much is it just restarting a series? Consider ADP hasn't been as bad of late. So, how are you guys looking at the job numbers and how much of a signal are you pulling out of it versus noise?
I think we're in a low hire, low fire environment, and that there's because of the uncertainty, a lot of hiring is on the sidelines, and they're not getting rid of people because they're trying to wait to see how some of these things are going to play out, and that's why you're seeing such low numbers. Last year, we're used to seeing situations where we got 200,000 jobs being created every month or more. And I think we saw a total, what, of 181,000 for the entire year last year. I mean, some ridiculous numbers. So I think it's a low hire, low fire environment for the time being until there's more certainty about the economy and how this war and other things are going to play out.
Well, it's also hard to find people to fill jobs too. I
Well,
mean, in some sectors like construction, my place in Florida, uh, all kinds of stories I could tell you about that in terms of finding workers now. It turns out that the people who enjoyed climbing up on the roof and retiling roofs in the middle of a Florida summer weren't documented laborers, and many of those folks are no longer there in the state. So there's labor market issues, so we just haven't had people step in to refill those jobs. But uh, anybody else? Does anybody else have views on
I
just how to interpret the numbers and the volatility there?
I want to just echo what Will said. I say don't quote me on this, but there's some stories written that like yeah, like we hiring is slow dramatically, but actually voluntary separation quits, like the quitting rate is at an all time. Maybe I'm not sure if it's an all time low or just it's a very at least cyclical low. So I mean, and that actually is more impactful on hiring than not, right? Because I mean, part of what necessitates a hire is somebody had to have quit a job, got fired or something happens. I do think in some of the headlines, there are a lot of companies, especially in the tech sector, that they were labor. I've heard the phrase labor hoarding, like they overhired at, expecting God knows what growth. So it's not really surprising that like if your hiring went like this, that maybe you're gonna have, mean reversion should never shock you. All that said, the consumer. I mean, we've been in a very bullish economy for a long time. I don't look at the COVID recession, which was an official recession, as a real recession. It's like more like a natural disaster, like like a hurricane mandated shutdown, like we have in Jim and I in Florida. Or Jim when Jim chooses to be in Florida. I mean, like, yeah, we know everyone doesn't come to work this week because we were under warning of this, and then oh by the way. Don't look at all the hires that happened 2 weeks later because they all come back. It's like so. I feel like COVID was that. So if you actually have a cyclical some just cyclical trends that companies are like, well, what the heck did we do here, right? it just wouldn't shock me, right? And I do think a lot of companies are saying like, well, is that a job or is that an AI agent or an AI function? So they don't want to hire because they just don't want to. They don't know which side to invest on. And I think,
You're worried that folks
yeah,
are just pulling back because, again, too
yeah.
much uncertainty. I'm not going to hire right now until I see how the rest of the world settles out.
Yeah.
Yeah.
Although I do want to make a point. Well, I think Will made the point about like how much work kind of like a $20 Claude subscription can do relative to, $100,000 worker. One interesting story I heard, and I have not found verification of this, nor do I think it because it's a private company that it maybe could be that some people have estimated that the $200 subscription from Anthropic's Claude might people might be figuring out how to get as much as $5,000 worth of compute out of it, right? That they might be subsidizing this, which,
So,
if that's all true, which wouldn't shock me. I mean, they're trying to, I mean, a lot of, Uber subsidized people's rides like crazy until all the cabs went out of business and they jacked your Uber price up. Um, it does make me question or wonder, is the scalability via data centers, power constraints, like, is it like to knock out 70% of a workforce, which I hear these numbers around, does the cost of compute actually, does it work? I don't
yeah,
know and I don't know the answer to that, but
yeah.
yeah.
We didn't have time to get into data centers. We went into so much, but I just want to give Will Pattison one last chance to talk about, his views on recent job numbers before we wrap it up. Will, how have you been reading the volatility and the reporting?
Well, I'll be quick because I know we're over time, but I'm not worried about it as it relates to the economy. I think the U.S. is just now in a almost, 0 to some number of basis points of population growth mode, as opposed to in the 1990s when population was growing 2 or 2.5%. So if we get only 20, 30,000 jobs per month of growth, that might be a neutral level or the level at which the unemployment rate remains unchanged. So I'm
Yeah.
not worried about it from an economy standpoint.
So we're at our time now. Number one, I want to thank everybody for staying and listening. But in summary, there's a lot of uncertainty out there right now. There's positives and negatives that are happening. In all these things, just as you see a new shock, think about it. Is it going to have some sort of deflationary or inflationary impact? And that's a way to think about it in terms of what the long-term impact might be for real estate. So with that, John, are you going to say
John.
a closing word?
Yeah, I want to thank the panel. You guys were terrific. The programming committee for pulling this together, and the CRE staff for their hard work behind the scenes. As always, watch your emails for details on upcoming webinars. And for the counselors, we have two meetings coming up. Our European meeting is in Amsterdam, June 17th to 19th, and this fall's annual conference in Dallas, September 30th to October 2nd. These are prime opportunities where the counselors get together, exchange views, and build camaraderie. Many thanks to all of you for sticking with us, and we'll look forward to seeing you next time.